We went over the multiple regression output that you would get in a Stata, like if you ran a regression in Stata. I'll show you Stata and Gretel on Monday, just a quick, like easy, like, I guess the basics of how to do regressions. But your Gretel is going to look fairly similar to this with the coefficients, the standard errors, all the same information. It'll just be in a slightly different like output. So anyone tell me from last class what the coefficient here means for the student-teacher ratio?
For every 1 unit change in the student-teacher ratio, it'll go down by 1.1.
That's right. And because it's we have a control variable in here, the percent English language students, holding the percentage of English as a second language students constant. So compared to the regression that we did before that was just the student-teacher ratio and test scores, this is getting us a more accurate result because we're controlling for something else that impacts the test scores. And now looking at the R squared, is this model, do you think this model is good? Does it capture what impacts the student test score? R squared right here. What's that? Not really? What number would you like to see it be? 7. All right, there's no magic number. If you remember the first one, a couple classes ago, it was 0.05. Now we're up to 0.42. So this is a lot better than the first one. Still not as good as we'd like to see. We'd like to see it higher. I'm not familiar with the education literature enough to know what the optimal R squared you're shooting for is. Like I mentioned with wages, the R squared you're going to get is a lot lower. So if that was anything above like 15, 18%, then we're happy with that. Oh, and the p-value for student-teacher ratio. Is this a good p-value? P-value is good. P is greater than the absolute value of T.
I mean, yes and no. It's still a good p-value, but it's higher than it was in the last regression.
Yeah, the first one it was 0, which was really good. This one it's 1.1%, which is still really good. If you have, remember the p-value is the probability that the coefficient that we estimated is due to random chance. So there's a 1.1% chance that it's due to randomness. So this is really good. Remember the 3 levels of statistical significance. There's weakly significant, which is between 10 and 5%. There's just statistical significance between 5 and 1%, which is this. And then there's strongly statistically significant, which is below 1%. So this is really close to being strongly statistically significant. So all in all, this is a pretty good model. It beats the first one for sure. But now if we're working with multiple regressions, so you have multiple variables, there's an additional assumption that there's no perfect multicollinearity between the variables. I know it sounds complex because it's a big stat term, but basically what it means is one of the regressors is not an exact linear function of one of the other regressors. So this is a very, very simple case of someone including the student-teacher ratio twice. Obviously, the student-teacher ratio is going to move with the student-teacher ratio as it changes because it's the same exact variable. A lot of times, your software packages will just drop it if they're exactly the same or really close to being the same. Yeah, because the OLS estimator is unable to distinguish between the two variables when they're exactly the same or when they're super close. Yes. So the perfect multicollinearity, like the student-teacher ratio being included twice, is often a mistake that economists make. Easy to click on one variable twice instead of just doing it once to put it in there. So that's usually easy to spot. But imperfect multicollinearity, that is more difficult. You need to do some thinking in order to catch that. So for instance, well, even for perfect multicollinearity, there still are some cases where it's more difficult. So an example I wrote down I wanted to remember is if you wanted to estimate like a store's total sales, and you also included their sales tax paid. Because the sales tax paid is going to be, what, in Pennsylvania, 6% of their total sales. These are going to move perfectly together. So you don't want to include both of those because it's going to suffer from this multicollinearity. It's going to be more difficult to accurately estimate your coefficient because you can't hold one constant. You can't hold the sales tax paid constant while the sales are increasing or decreasing because the sales tax moves like at a 1-to-1 ratio with the total sales. Something else to be aware of is what's called the dummy variable trap. If you have a set of dummy variables, these are binary, so it'll be like 1 if, say you have regions. You have north, south, east, and west. You have 1 if it's north, 0 if it's one of the other three regions. 1 if it's west, 0 if it's one of the other 3 regions. You have all those variables. If you would include all 4 of those in your regression, you're going to suffer from this perfect multicollinearity. So the easiest way to counteract this is just to drop one of those variables. So include north, south, east, and then don't include west. If you're doing stuff that involves human capital and you want to include individual characteristics, say like male and female, you would just include female or just include male. You drop the other one. Another option is to drop the intercept and to not include that, and then you also wouldn't suffer from multicollinearity. But I think the easiest way is to just drop one of the dummy variables. Yeah. So, like I said earlier, imperfect multicollinearity is something we encounter a lot more, and it's more difficult to try to test out to see if it's present. So the relationship isn't perfect between 2 variables. If you imagine a scatter plot of one of the variables from before, if we were talking about total sales for a firm and sales tax, they're going to move together like that, in like a 1-to-1 relationship. For imperfect multicollinearity, we're not going to see them move perfectly like that, but we'll see like that. We'll see a pretty tight scatter plot, and it'll be moving clearly in one direction. Yeah, so basically what the slide is saying that it's collinear is, for perfect multicollinear, it's going to be literally one line. That's what the collinear means. And if it's not perfect, if it doesn't exactly follow that line, that's when you're going to get the scatter plot, where it's very similar, but not quite exactly the same. So imperfect multicollinearity implies that one or more of the regression coefficients will be imprecisely estimated. Again, you can't hold one variable constant and try to estimate the effect in the other variable if they're highly correlated, because when one moves, the other is going to move. So it makes estimating your coefficient very difficult. And that's the whole point that we're running these regressions, that we're trying to model these, so that it ruins the accuracy of your model. So for an example, if you were looking at, or if you included, you were trying to estimate the gasoline usage, and you wanted to include the number of cars and the number of miles of highway in a state. These are likely to be highly correlated together. So you're going to suffer from imperfect multicollinearity. They're not going to be like a perfect 1-for-1, but a state that has more cars is more likely to have a lot more highway, just because of the greater number of people living there. In this case, your coefficient is still going to be unbiased, so it's not going to be super inaccurate, but it's going to, the variance that you're going to get on your estimates for the coefficient is going to be spread wider. So you're going to lose statistical significance even when there is a good relationship between the two. So the question is what to do when you think you're suffering from imperfect multicollinearity. One option is to do nothing. If you have statistical significance with most of your variables, then they say it's not a serious problem that you're going to have to deal with. And in that case, you can keep all the variables in. You can also drop variables if one does destroy the statistical significance of another variable. You can drop that variable and run the model again and see if you have statistical significance this time. Finally, you can also increase the sample size if this is possible. Include more observations, so that way you can get a more accurate estimate even with the collinear variables. So now that we're done with your simple cross-section, we're going to look at time series data. For some of you, for your projects, you may need to use time series data, especially if you're looking at what's going to happen in one country over time as monetary policy effects on whatever measure you're looking at. So for time series data, you're looking at data collected the same observational unit over multiple time periods. So in one country, you're looking at GDP over 20 years. You're looking at exchange rates between the yen, the pound, and the euro. Maybe you want to look at the US over 50 years and look at the Federal Reserve's forward guidance, that the messages they give about the future of monetary policy, how that's going to impact, say, the bond market. Again, it makes sense only look at one country when you're doing this. A lot of times there's substantial differences between countries that is going to make modeling this very difficult. It's also useful to use a time series when there's one variable that affects another over time. So if you want to look at, say, the money supply, how that impacts GDP. Because remember, monetary policy works with long and variable lags. So when a central bank implements a policy, it doesn't have an immediate effect and that's it. It takes time to realize the full effect of this. If you're going to look at money supply and GDP, you're going to need to include GDP over several time periods. These are called lagged variables. So you look at, say it's the money supply in 2010, or GDP in 2010 and the money supply in 2010. You're also going to want to include GDP in, say, 2009, GDP in 2008 in past years, because the GDP in a past year influences what the GDP is going to be this year. The number isn't truly independent, that the level of GDP is partially determined by the GDP the year before. If you wanted to try to do this using ordinary least squares, using several lags, you would suffer from multicollinearity, and it would lead to an inaccurate model. So here are some examples of time series data. Here you have payroll employment in the United States, again, over time, over 50 years. The percentage change in payroll employment. What else? The civilian unemployment rate, 12-month CPI. These are all sorts of data that you may use for your project. And remember, Fred was a really good source. I think it doesn't say if these come from Fred, but Fred is a really good source to get all that data. You can get it annually, quarterly, some of it monthly. So some of the uses of time series data. One of the primary uses is forecasting. So you look at what's been going on over the past, say, 20 years, and then try to estimate what that means for what's going to happen next year. It's very useful if you're involved in the stock market, trying to estimate stocks. You can estimate dynamic causal effects. So if the Fed increases the federal funds rate now, what's going to be the effect on the rates of inflation and unemployment in 3 months or in 12 months? Again, because it doesn't have an immediate effect, to see when does it take effect and how much is that effect going to be. What is the effect over time of cigarette consumption of a tax hike on cigarettes? Obviously, people aren't going to change their behavior immediately. It's going to take some time. And there's an interesting question of over time, how does tax policy affect people as they're forced to adjust their budgets, especially cigarettes, because they're addictive. People won't be able to quit right away. That may take time. So it's a policy that won't have an immediate impact, or all of the impact won't be immediate. You can model risk in financial markets. And there's a lot of applications outside. So environmental and climate modeling, that's obviously huge, where they try to look at the past temperature of the Earth, different characteristics of the Earth over that time, and use that to estimate what the temperature is going to be in the future. Engineers use it, computer science. There's a lot of other applications for it. So there are some new issues they're going to be dealing with time series that we have not had to deal with the ordinary least squares regression. So we have time lags. We have policy going into effect in one period, but that impact is spread out over multiple periods. So something we need to think about is how many lags should we include? How many lag variables should we include to account for the slow effect? There's also correlation over time, which is called serial correlation, something that also takes place in panel data, which we're going to talk about next. And how to calculate the standard errors when the errors are serial correlated. We're not going to worry about that right now, but that's just another issue, because the time series is pretty different from ordinary least squares. And they suggest a good way to learn about it is to investigate for yourself, so play around with stuff on Fred. Here's an example of a very simple time series model. Here's our aggregate consumption model from the example I mentioned a minute ago. So current GDP is going to be affected by the money supply in the current period, and then by past GDP. So in this case, I include two lag terms of GDP. So GDP in 2019, this year is affected by this year's money supply, and then last year's GDP and GDP from the year before that. You can have a model with several more lag variables in it if the literature suggests that that's a good, accurate way to model whatever change you're looking at. That's a good way to try to determine what, or in this case, how many lags to do. Or maybe to look for control variables is to look at other literature that's been published on the subject to get an idea of what they suggest you include, what is considered appropriate in the profession to use. All right, so for time series, if you're using Stata, or I'll say first, if you're using Gretel, it's very simple. Gretel is a point and click. There's no coding involved. So you can just select the time series model. I'll walk you through this later in case you need to use this for your project. You select the variables, the number of lags, and then it outputs the result for you. Stata is a little bit more difficult. There's a little bit of coding involved, but you're basically just telling it to run what they call an autoregression, which is what you use for a time series. I'll also give you an example of that for code, and I'll put that on Canvas. I'll put it on Canvas so you have like a template if that's something that you would need to use for your paper. Next is panel data. This is the best type of data set to work with. So it has observations on multiple entities. So for instance, say individuals. You've got 200 individuals that you're measuring over 10 years. So for our example, say the test scores, we're looking at that again, but instead of just 1 year, we now have those 420 school districts in 1999 and in 2000. So we can follow them up the next year. If you take data for all 50 US states, we'll take it over a 3-year period. Or if you have 1,000 individuals in 4 months, you now have 4,000 observations in total. So basically what you have is several cross sections building up over time. In a true panel data set, it's going to be the same ones. So for instance, like the US states, you have them all the same states, all the same variables over time. There's some data sets of pooled cross section, which is basically the same. That's if you have, say, the 1,000 individuals. You have a sample of 1,000 random individuals, but it's a different 1,000 people each year. It's similar, but not quite the same as panel data. Although luckily for your projects, if you would use something like this, it'll be a panel data set. It won't be the pooled cross sections. Now, why is panel data useful? Panel data set we can control for factors that vary across entities but don't vary over time. So if there's differences between each US state that are the same, say maybe it's a cultural. We'll talk about culture. If there's a cultural thing that you can't quite measure, so you can't create a variable to control for it. If they're constant in those states over time, they can be different between the states, but the state isn't changing over time. You can control for that just by virtue of using this data set that goes over multiple years. If you're using a cross section, you would get omitted variable bias because you didn't include these because they're relevant. But with a panel data set, you can control for them. There's also data that's unobserved or unmeasured, again, that you cannot get, that can be controlled for by using this type of data. Also, something else to note, policies may have an immediate but short-lasting impact. So Head Start, the preschool program that's funded by the government, it has a substantial impact in students for like kindergarten, first grade, second grade. But by either third grade or fourth grade, the difference, like the benefit from attending Head Start completely dissipates. And they're no different than students that didn't attend Head Start. There's also policies or things that have a slower long-term effect that you don't see right away, but you can, as the years go on, you can see. So for an example, I wrote down infant health and wages. If infants are born like heavier, they're not, I guess, like underweight or malnourished when they're born, they tend to have higher wages when they grow up. Probably wasn't the best example. Maybe not even the smoking wouldn't have been that great because that has a big immediate impact and then that increases over time. But again, because we're using panel data, we can see whether these impacts begin slow and then grow over time or whether there's a big impact initially that fades away over time. We can get a lot more understanding about what the effect of a change in policy is. That's just another reason why using panel data is great. So here we have a data output for the impact. Yeah, the impact of traffic deaths from the beer tax level in the state. So the beer tax is what's called a Pigouvian tax. It's meant to, it's when you place a tax on an action that has a negative externality in an effort to reduce the people engaging in that act. So in this case, people drinking beer has a negative externality. There's an increase in traffic deaths from people driving drunk. So in order to force people to bear more of that cost, they place a tax on people that drink beer. And the goal is for people, because it's now more expensive for them to drink beer, they're going to drink less beer and we'll have fewer traffic deaths. So trying to estimate what the effect of beer taxes on traffic deaths is, first of all, it's a way to test whether this hypothesis holds true, whether making an action more costly is going to reduce the number of people that engage in that action. And also, it's an opportunity to try to measure what the effect is, to actually estimate how much or how many traffic deaths can we prevent by increasing beer taxes by whatever, by a certain amount. So the other day I talked about moral hazard in the financial industry, about how things like insurance that makes negative things less costly, how that can how they cause moral hazard. It encourages them to take more risks than is prudent. So since we're talking about traffic deaths, do you guys have any idea of how insurance can cause moral hazard for driving? By having car insurance, how does that? I don't want to give away the answer. How does it make? Why would having insurance allow people or encourage people to engage in more risky behavior while driving?
Because if something happens, there's some people you have on.
Yeah, so they don't bear the full cost of it because their insurance is picking up some of it. Do you have an idea of how to actually reduce traffic deaths or traffic accidents? To make it more costly?
Gas prices.
Increase gas prices? That is one way, make it more costly to drive. Like Gordon Tullock once said, if you really wanted to increase, or I guess decrease the number of car accidents, put a giant spike on the steering wheel pointed right at the driver's chest. If you get in a car accident, you're gonna die from that. So no one's gonna, you're gonna be really careful driving. No one's gonna go more than like 15 miles an hour. Obviously, it's not the most practical suggestion. It's not the safest, but that's how to encourage people. I just want to note for this is what you would do in Stata if you type in XT set state here to tell Stata that you have a panel data set, and this is the output. And here it says strongly balanced. What it means by strongly balanced is that you have all of the same years and variables for let's say for each of the variables. That doesn't make sense. You have the same number of variables for each cross section and the same number of years. So if you, I said no math, but I'll matrix real quick. You have x1, x2, x3, y1, y2, y3. So you've got, say, 3 years here, and then the 2 variables for both. If you were missing y3 there, that would be unbalanced because you don't have all the same variables and years for each cross section. Obviously, having a balanced panel data set is better than having unbalanced panel data set. So here we have the output for Stata. Okay, we're running, because we set it, we use the XT set. We're now using XTRay to tell it that we're using panel data. We want to run regression on panel data. And then just the vehicle accident rate and the beer tax. And then we did fixed effects, and we clustered our standard error by states. I'll leave that go, what that means for right now. But if you guys would be working with panel data for your project, that's something we can talk about why you would use that. So here's our output. There's a few more stuff up here above, but it's the same basic output down here for our coefficients that we saw before. So our beer tax, the coefficient is negative 0.655. Can someone tell me what that means? This is the same as the regressions we did before. So a 1 unit change in the beer tax, let's say they don't have data here for it. So let's say a $1 increase in the beer tax is associated with a 0.65 reduction in the rate of vehicle accidents. So it's the same way we interpreted the coefficients before. Now the p-value, 0.029, so it's statistically significant. It's a good thing. What else do I want to talk about? So some of, even though most of this is the same, here we have, there's r squared within and between, so that's within each state, and then between the states. But then if this is overall, this is the r squared that you want to look at, it's at 9%. So again, these are the same sorts of things that we had with same sort of measures, and we interpret them the same way with panel data. But some of the mechanics behind it are slightly different. So in this, each unit, so in this case, each state, you estimate its own intercept with the y-axis, and then you measure the effect for like each state. If you would try a typical OLS regression, it may not fit the data properly. So if you had one state like that, another state like that, another state like that, you have a negative relationship between each one. But because of the way the data just happens to each state go upwards like that, your OLS could estimate line of best fit going up, and you've got it completely wrong. So that's why it's important to use the XT set and the XT reg. Or if you're using Gretel, you just go to panel data and to run the model that way. Point and click is much easier. To account for problems like that, the data. That's just something to remember. So this, and now regression with time fixed effects. So an emitted variable, it might vary over time, but it doesn't vary across states. So if you're looking at, go back to the auto accident example, traffic accident deaths. Cars got safer over time. I'm almost afraid to mention this. Do you guys even remember Ralph Nader? Ruined the 2000 election. Okay, so he was run for third party like for several elections. He got really big talking about car safety back in the 70s, because if you ever like been in a classic car, they might have a seatbelt that goes across your waist but doesn't even like go over your shoulder. Steering wheels and the whole front dashboard were like metal. They were super unsafe. Over time, cars got a lot safer. Now they have like lane assist if you start to drift to the side. The new Subaru has something where like it like watches your eyes, and if it catches you not paying attention, it'll like blink or something to like get you to look back on the road. They become much safer over time. Generally, it's going to be the same across states. You know, generally they're going to have access to like the same new cars, but over time they're differing. So if you're using panel data, it's often important to use time fixed effects to account for things that are changing over time. So for this example, you got your variable of interest, your coefficients, you got the x variable that's going to be affecting the y variable that you're trying to test for, your z variable, your control variable, and finally your state fixed effect. That's just what that model means there. So for those of you, if your paper, you want to look at several countries over time, maybe compare their performance to their central banks, a panel data set would be really effective for you. It'd be a good way to design a model. If you were looking at the actions of the Federal Reserve. So you want to look at Federal Reserve forward guidance and how that affects interest rates. There was a big shift when they decided to start using forward guidance during the financial crisis. But if you want to test, well, is this really effective or not? You would just want to look at the United States, and you would use a time series to try to understand that. Do you guys have any questions about time series or about panel data sets? Unfortunately, Christy isn't here, and we were going to walk through designing her project. Does anyone else want to volunteer? Max, you want to pick one of your one of your 6 choices?
I don't have any data though
You don't need data. We're not going to write the code for you. We're going to talk about what type of data set you would need, what variables you want to control.
I'm not sure where I'm going to go if we ever do shadow banking.
Okay. Can you explain what shadow banking is real quick?
Yeah, so it's, well, kind of, I don't know. I'm just reading about it right now. It's something to do with like, isn't like off balance sheet? It's non-regulated financial intermediaries.
So they're not typical banks
Yeah,
that are being regulated. It's other institutions.
Yeah, and they are, I don't really know too much about it yet, but I know that they had a big to do with the financial crisis in 2015.
Okay, so you want to look at the proliferation of these shadow banks and what?
Performance measured with the economy. I don't know if they were
So how they impact GDP?
something like that, yeah. I'm not sure exactly what I'm going to do yet. I just know it has to do with shadow banking and trying to figure out right now how to measure that.
Okay, so the impact of shadow banks on GDP. So you have to just figure out what's a way to measure shadow banks. So something about their size. So maybe like the number of assets.
Yeah. The F, this is FBS or something like that. That must be, has like this whole calculation of narrowing down metrics that they use to figure out how much the size of the shadow banking is. It's kind of crazy. I'm reading about it right now.
Okay, so how do they narrow down or to determine like the size of shadow bank?
We're looking at 5 different sectors: repos, on-bank, intermediaries, ABCPs, securitization, and MMFs. And then further, you like subtract.
Do they combine those into like one metric at the end?
Kind of, yeah.
Okay.
They subtract out OFIs, pension funds, insurance corporations, and financial auxiliaries. And then they get like this statistical residual, and then they narrow that down to a measure of shadow banking.
Okay, so we'll just call that their index, their shadow banking index. So are you going to want to do this in the U.S. over time?
Yeah.
Or are you going to want to compare the U.S. across countries?
I'm just going to try to do the US over time.
U.S. over time, all right.
It seems like they have,
So if you're doing the U.S. over time, it's a time series.
yeah.
So the time series, you're going to need to run some sort of auto regression.
Okay.
I'll write that down, an AR. So you're going to want to include lag GDP for the shadow index. Is it annually or quarterly?
They don't really have like an index. I'm trying to like find out where they got their data from, and then I was gonna like do my
Okay. let's just say it's annual right now, for sake of argument. So we're going to have what, lambda GDP t minus 1, and we might include a couple more lag terms. But what else is known to affect GDP? In the macroeconomy, think of the related variables. Unemployment rate. It's another Greek letter. What else could have an impact on a country's GDP?
There have to be like constant like tariffs or in case of Brexit being an issue. Or is it not like relative to tariffs?
I think tariffs are too much a component of GDP. You're going to have collinearity there. But something like Brexit, I don't know, that wouldn't affect the US really. Or we wouldn't see like a strong effect for the US. But if we were looking at Britain, we would need something to account for that. Maybe dummy variable pre and post Brexit. There's another big one that's related. Unemployment, GDP. Close. Inflation. We usually use pi to represent inflation because I usually is used for interest rates. So now, how far back does shadow banking go, Max? Do you know? Have any idea? Does your index say that?
I just started reading about this, but this like specifically talks about like leading up to the financial crisis. I'm sure it gets back to way before then.
Okay, so in the lead up to 2008, so we're talking like at least 2000, right? That shadow banking was a thing.
Mm-hmm.
So if it goes back to at least 2000, you'll probably want to get data even before that, to when it wasn't really a thing. There didn't really have an impact. So you might want to go back, say, say 1985. If you go back too far, back into like the early 80s and late 70s, you deal with the stagflation and the super high interest rates and inflation that we dealt with back then. So it may not work so well with your model. Something else to consider, you said it broke down the shadow banking by like several different like measures.
Yeah, sectors.
Or sectors. You could look at each of those sectors to see if maybe if one of those in particular had an impact that others didn't. Oh yeah, I know there's a ton. We're just trying to design a basic model, not go into the background of shadow banking. Anyone else have suggestions for this? Luckily, all these variables, well, besides the shadow index, but GDP, unemployment, inflation, those are easy to get. You can go to Fred and get them annually, quarterly. Some of them are available monthly, but I think quarterly is all you can get for GDP. So that'll be very easy to get that data, to download it, and to begin working with it. shadow index, apparently, like your index of shadow banking will be easy to find. Some things are more difficult to find. If you wanted to look at the impact, or maybe use as a control variable, and you're looking at panel data.
How do you calculate cross-border interconnectedness? Because the banks are so connected across different countries. This is possible here.
Does it? Well, the bank would still be in the United States, right? This will be operating in the U.S. Does it have its U.S. assets or its total assets?
Like I said, like,
Yeah, see, that's something to think about. I don't know if that would be a problem, but that's something to think about.
but like I said, I'm trying to use their metrics for like my own. You know what I mean?
Yeah. All right. With that, it's 1 minute of the end of class. You guys have any questions before we break out? Okay. Then on Monday, when you come back, we'll do a quick walkthrough of Chrissy's paper. Because I told her I would. So, well, she's not here to even suggest or like to say what her topic was for you guys to think about it over the weekend. But it'll be another exercise to try to think of what type of data should we be using, what type of model would be appropriate, just how to design it. And then we'll start moving into the Federal Reserve and how the Federal Reserve operates.